Hi guys, my name is Anirudh. Hope you guys liked our first video that we shared. In these times when markets are crashing, the economy is going nowhere, everyone is saying what is going to happen. I thought it will be interesting to share tips on stock investing from none other than the guru himself. So this week we're going to discuss One Up on Wall Street by Peter Lynch. So, One Up on Wall Street, written by Peter Lynch, the erstwhile fund manager of Fidelity Magellan Fund, which had assets under management of somewhere about $3 billion at the time when it was the late 70s, full 80s. And to give you the perspective on this fund, $3 billion at that point, it would be equal to the entire population of the world had put in 60 cents and gave him to manage it. That is the magnanimity of this fund. Now, it is one of my personal favorites to facilitate mindset conditioning for investing. This book targets stock investing in particular. I would put it right in the league of Rich Dad Poor Dad and The Intelligent Investor. So, here it goes. So, question number one that would come to anyone's mind before starting investing is, who? Me? How could I possibly be better at investing than my professional consultant? The average common investor, which is you and me, have an edge over professional investors because we can simply cite multibaggers from the beginning of their business in our day-to-day life. The business reaches a professional investor once it has already taken multifold leaps. Imagine a new store that is opened in your neighborhood and it is always flooded with customers. You must wonder who owns it and is it listed? A stock doesn't get traction by professional houses as a lot of times the business doesn't get classified into existing industry categories. We all know how data management and fixed templates work in most offices. Other times they just take too long to put it on their watch list. It's like the choice between making a large profit on an unknown company versus losing a small amount on an unknown company. It's like at that point in time, the author said, you'll never lose your job losing money on IBM. If IBM stock does not rise, fund managers will never question the decision to buy IBM. They'll simply ask, what's wrong with IBM? Remember, fund managers are also employees. Just like you and me, they spend almost a quarter of their time getting into useless reviews and explaining their decisions to their immediate bosses and their ultimate bosses, which are shareholders, you and me, right? And both of these people, their immediate boss and their shareholders, have a very massive impact on their careers. The SEC or SEBI in India's context also puts on a lot of well-intentioned restrictions on holdings of funds. This may rule out a lot of multi-baggers. When things were fine, I think a couple of years ago when I read this book, I remember very firmly that I had an investing in a small cap company which was good with its fundamentals, only to witness its share price tanking. I could only link it to one reason, that SEBI had put in restrictions on funds classified as mid cap stroke large cap, that they cannot have a certain percentage holding of small cap shares. So all of them just dumped small cap and my investment simply tanked. Okay, so question number two that will come to our mind is, I may have an edge, but I don't understand any numbers or any industry in depth. Do you really want me to start learning everything from scratch? You see, investing in stocks is an art, not a science. All the math that you need to understand stocks, you get in the fourth grade. Always remember, the stock market is a voting machine and not a weighing machine. And here, the votes swing in the favor of the company with the strongest fundamentals in the long term. Most dot-coms or startups in today's reference cannot be rated on the standard P by E yardstick because there is no E in the all important P by E ratio, which is price upon earnings. There is no track of E, but people simply go and keep a track of P every time. This is absolutely useless. This will not give you any information. A company called EDS once sold at 500 times its earnings. That means its P by E was 500. You guys know what that means? It simply means it would take 500 years to make back your money if EDS maintained its earning as a constant. If you don't understand any industry or technology, it's okay. Look for industries that benefit directly from it or indirectly from it. In the gold rush, the would-be miners lost a lot of money, but the ones who provided them with picks, shovels, and the all-important blue denim jeans, they made a lot of money. Instead of manufacturer of technology, which is a highly competitive area, better invest in a company which is a user of that technology. Question number 3. But there are a lot of companies out there. Where do I start or how do I filter? Step number 1. Possess these simple virtues, namely patience, self-reliance, common sense, tolerance for pain, open-mindedness, detachment, persistence, humility, willingness to do independent research, very important, and admit mistakes. Once you possess these virtues, try and classify the companies into 6 broad categories: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. Any idiot can run this company is one characteristic of the perfect company, the kind of stock I dream about. To explain this further, invest in companies that have products that people simply have to keep buying, like clothes, basic hygiene, packaging, FMCG. All these are here to stay till the time humans walk this planet. Now would be a very good time to look around what you are consuming in this time of lockdown. Peter Lynch says a no growth industry is where winners are developed. Whenever the next breakthrough arrives in an industry, there are hundreds of companies working to make it cheaper in Taiwan or China. This does not happen with simple bottle caps, oil drums, or simple motel chains. Now you guys would be thinking, well, this seems easy. Are there any nuances that I must take care of? Yes. Before you own a share of anything, answer 3 simple questions for yourself. Do I own a house? Do I need the money in the near term? And do I have the personal qualities? Remember, we listed 10 personal qualities that will bring me success in stocks. If the answer to any one of these questions is no, stop. Once you have a tip or you've yourself identified a good business, do not simply go ahead and buy it. Investing without research is like playing stud poker and never even looking at the cards. It's easy to forget sometimes that a share of stock is simply not a lottery ticket. It's part ownership of the business. It is serious. Value will eventually catch up with its earnings, so always keep an eye on the earnings and the assets. Compare growth to earnings. A good metric would be long-term growth plus dividend yield divided by the P/E ratio. It will give you a good perspective. Some learning on each stock before you buy it that you must possess is the P/E, percentage institutional ownership, lower the better, insider buying or buyback, trend of earnings, keep in mind the asset play, debt equity ratio, and the cash position of the company. But it is also essential to look at the quality of earnings. There are 5 basic ways in which companies can increase their earnings. A. Reduce cost. B. Raise the price or the revenue. Expand into a new market. Sell more in an old market. Or dispose of a losing operation. Simply get rid of it. When in doubt, tune in later. Have patience. Most importantly, invest at least as much time as you would invest in buying a refrigerator, or in today's time in buying your new mobile phone. Now you guys would be thinking, okay, we got all the virtues, we got all the industry classifications. Is there anything that I need to be wary of? You don't need to make money on every stock that you pick. As per Peter Lynch, 6 on 10 stocks, if they are winners, they can produce a very satisfying result. If only there was a way to avoid looking at that ticker day in, day out and have a look at the ups and the downs and have your BP run after it. Peter Lynch gives a very good advice on this. check the stock price every 6 months or so, just as you would check the oil in your car. Because the day trading, it only supports the livelihood of a lot of accountants and brokers. As Robert Kiyosaki, one of my favorites, put it, whether you make money or not on any deal, your broker does make money every time. First of all, remember, timing the market is a very bad habit. You cannot really do it. I am a supply chain professional, and I've read forecasting, but the ultimate truth about forecasting is it is always wrong. So timing the market, a complete no-no. And there are three emotions that basically humans go through and make us very bad timers of the market. Number one, concern. When the market is low, which is right now, we are very concerned and we do not buy good companies. So right now is a very good time to buy good companies. Second emotion that we go through is complacency. When the market is going high and we've already bought a share at a higher price, the market still keeps on going higher, we get complacent. We forget to keep a track of the fundamentals of the company. And the third emotion is when the stock price falls below our buy price, we simply capitulate and sell it off. So the three C's of emotion are something we need to be wary of. If inventories are rising faster than the sales, it's a red flag. Remember, people may talk a lot about FIFO or LIFO in accounting principles, but in most times in life, it is only GIGO, garbage in, garbage out, and as Peter Lynch puts it, fish, first in and still here. Regarding someone else's gain on a particular stock as your own personal loss is not a productive attitude in stock investing. What happens is it leads to try and catch up by buying the stocks at a higher price which you shouldn't buy. This generally leads in real losses. So that imaginary gain that you talked about leads to a real loss. Short-term gains or losses don't tell much about a prospect. Most people simply keep the winners and dump the losers. This is way farther from the truth. It just simply tells you that at that point in time, someone else is willing to pay more or less for that merchandise that you bought. So always remember, invest for the long term. It is about the fundamentals. The mindset has to change from if it is down 25%, I am selling it, to if it's down 25%, I am buying it more because I am a believer of the fundamentals of the organization. So we've understood a lot about investing now. Let's get to the last point, which is the most crucial one, because that is where we realize our gains. When do I sell it? The answer is simple. Check fundamentals. If it's off, sell it. To facilitate this decision making further for you, there are some signs for each of the 6 categories of industries that we discussed earlier. For a slow grower, if it is losing market share for 2 consecutive years and has hired a massive advertising agency, it's a sign that you sell. For a stalwart, if the growth is slowing down and it is still maintaining its profits by cutting its cost, you sell. For a cyclical business, if the inventories go up and rather than modernizing its plants, the company invests more in capital budget, it's a sign to sell. For a fast grower, when the P by E has reached absurdly high levels, which are way beyond your own lifetime, or at least 3 magazines or blogs in today's time have fawned over the CEO and same store sales are decreasing, you sell. For turnarounds, well, when they've actually turned around, you would have reclassified them into one of the other categories. And if the debt certainly goes up, you sell. For asset play, if the assets were marked down compared to last year in the balance sheet and the institutional ownership has gone up, you sell. To summarize, check fundamentals, stay there for the long term, and use this time of lockdown and the current market situation to make yourselves better informed and make good choices, buy the right stocks, and hopefully it will be worth it.